Thank you all for coming today. As Rod said, we could be anywhere. So we spent a little time together as a crew, and it is funding the frontier. So we like to define terms. My background's risk management. Um, I started in the late '80s in convertible bonds, and went on to open and close a hedge fund because I missed a turn. I'm not missing this turn. That's why I'm here. Opportunities come in regimes, and this is obviously one of them. So I'm tasked with identifying the frontiers. It's physical. That's why we're in Texas. It is about compute, which is it's a new conceit that we're talking about with these panelists, and it's about funding. So we're talking about the convergence of those three. How are we going to fund the frontier? And those are three disparate assets and vectors that didn't exist, and no better place than Texas to talk about it. So we have three panelists. We have Baron. I'm going to talk to you about finance. According to Claude, you are about the market, and Andrew brings the physical. So we're going to hopefully talk about what I think is not just the power purchase agreements from the monsters, but a lot about the funding the operations to keep miners in the game to get through this just storm of attention on the meters, on the energy. So I'd like to start. I think we agreed that, Haley, a little bit about yourself, about what you do, how you do it, and then we'll go around the rest. Thanks.
So Haley Thompson, Director of Energy at Luxor Technologies. So my background is split between energy trading, pretty focused in ERCOT, and running a Bitcoin miner. And now I work at Luxor, trying to be a Bitcoin native energy company. And we launched our product about 10 months ago. And we're all about helping miners succeed. Luxor started off as a Bitcoin mining pool, which was in of itself, it was kind of a finance product. But over time, we've really diversified to kind of find miners' pain points and offer services. And through our through hash rate derivatives, we've kind of found a market fit that really is financing and capitalization. So that's kind
And
of.
financing the operations, the working capital, and the assets that reside within it, not ASICs particular, right?
What we actually like with hash rate derivatives, we basically commoditize compute, and we see that hash rate online, it's the stream of value. It's fairly certain for operators, and so we allow miners to not only monetize that and kind of bring that value forward, but also lock it in at a certain value and actually become more financeable for external parties. But really, what we do is we're agnostic to what they want to do with the funds. Basically, it's a forward sell of the main commodity they're producing, and then they can buy ASICs, they can buy new containers, they could even get into buy GPUs and get into HPC if they wish.
Optionality. So Baron and I spoke, and he smelled and looked like me in the beginning because you came from finance. So can you talk about how the allocation of capital was there, and whether it's efficient, and what brought you here to
Yeah, for
Brains?
sure. So first we sat in a different order than our names, but I'm on the left. I'm Baron Koch from Brains. I'm the sorry. Okay. So head of capital markets for Brains, and yeah, like Mark said, came from traditional finance, and I'm a native Texan, and I've spent my entire career flying back and forth between here and New York, and kind of being an outsider. And no offense, Mark, but it's really great to be a part of an industry where it's very Texas centric. I was raised in Austin, and hearing all the talk about Austin is just refreshing to me. And I guess I first want to say, as an Austinite, we've always been the live music capital of the world. We're now, I think, the comedy capital of the world. And I think if we could be the Bitcoin capital of the world, it would be a really awesome thing. So keep it up, Rod. But yeah, from my perspective, I mean, I spent my career as an allocator of multi-billion-dollar portfolios, and two things kind of collided. I think I've considered myself a finance nerd, and have spent a lot of time deep in the concepts of finance, and there always was something that was kind of like missing. And rather than call it a Bitcoin rabbit hole, I like to think of it as an education. And as I had that education, it so perfectly kind of filled like the gaps of what I didn't receive on the traditional side. So that was one part of it. And then just as an allocator, I think the reality is that you have to unfortunately level up the size of your portfolio, in order to advance your career. And I found myself in the senior seat of a multi-billion-dollar portfolio, which is great. And there's a lot of good things to say about it, but the skill set that's optimized for in that industry is more political than investing skill, and it just wasn't, to me, a fulfilling way to spend the next several decades of my career. So that's really what kind of brought me here. So Brains, as you may know, I think we're one of the oldest Bitcoin companies in existence. Started as Slush Pool. If you've been mining a while, you're probably familiar. That was in 2010, became Brains in 2011. So Brains offers, in addition to the pool, firmware, fleet management, like pretty much software for miners. And as we look to grow the business, we're looking to serve miners in additional ways. And that was why I was brought on, is to kind of be over the capital markets and financial efforts there. And I can speak a little bit more about it, but you may have seen, we announced last week an acquisition of a commodities hedge fund. And I think this gets to where our paths kind of come together, Mark, is that, what we're trying to put forth to the
Well,
Bitcoin.
you made it clear that I'm from New York and that ain't Austin. So keep going.
Fair enough. But yeah, I mean, basically what we're trying to say, and I'm glad the panel before us talked so much about hedging, because it's really near and dear to my heart. And seeing the way the industry approaches hedging, and I think the derivatives market that the hash rate derivatives market was a huge step forward. And I think what we're trying to posit is that rather than just looking at the solutions that bankers are bringing, I think it makes sense to look at the history of commodities and learn from what other commodities markets have done. And I mean, I can speak more about this. I don't want to eat up too much time, but basically, all commodities throughout history have followed a similar trajectory, a similar pattern. And we think Bitcoin is really ready for the next step. And I think we're all familiar with gold, and it's 1971 is kind of like a key year for Bitcoiners. That was when it depegged. I think that's really when it went from like a reserve asset to price discovery, and then it goes into static hedging, and that's really kind of where Bitcoin is at right now in our view. And if we move to a more dynamic approach in how we manage our Bitcoin exposure, I think there's a lot of benefits that can come with that. But that's kind of the intro to that acquisition.
Thank you. Yeah, and we're going to touch on that arc of the financial development of the previous market to this one. Now, Andrew, the physical, energy, mining, and then powered. We're going to talk about our new term at the end. All right.
Fair.
All right.
Andrew Myers, CEO at Satoshi Energy. Been in energy for about 15 years. Started Satoshi Energy about 8 years ago. The mission has always been and remains, how do we get Bitcoin and Bitcoin mining into the hands of energy companies? And when we started, the industry is still not quite there and being ready to settle in Bitcoin or use Bitcoin as collateral. But I think they said on the last panel, we're getting very close on a lot of those things. So we started developing powered land, is what we call it. So developing sites for data centers, typically co-located with power generation. Our first 3 big projects were in Texas, and they were Bitcoin data centers, Bitcoin mining facilities. Now most of the sites that we're developing are going to AI companies, large hyperscalers. They're paying a premium. They're looking for that sort of scale, kind of pricing out Bitcoin miners in the market. But both are very exciting, and I think there's a lot of synergies between both AI and Bitcoin.
Right. And so that's the tension. The tension is that you're Texas, you have, and I'm going to throw the term out now. When we were talking, Andrew said powered land, and I heard power gland. And I think that power gland really represents what this panel is that it's not really just an asset. It is a biological system that when you add hash rate and when you add the optionality, you take and you weaponize the raw material into something that responds to load. And so even though Bitcoiners are being priced out, the intelligence you have, and I'm going to go back now to Baron about unlocks, the intelligence you have from the data that Dr. Paez talked about, the hash rate that you're developing and that forward. We love certainty in finance. And Baron, when you're talking about bringing on a commodities firm, can you go back to 1971, 1974, and how we are back to trading places, Eddie Murphy, orange juice futures? and how Salomon Brothers and Fibro were the big shift changing it. And I'm not going to say that your acquisition, the commodities firm, is the equivalent, but that's where we are. We're physical, and Texas has a unique position. And then talk about some of your opportunities about powering the gland, making it intelligent, making it responsive for your clients.
Yeah, sure. So, I mean, I think 1971 is very familiar to people just because it was, like really a pivot point for the fiat system. And but what happened after that was kind of equally as interesting. So in 74, that's when the CFTC was created, and it allowed, the existence of futures on gold. So if we use gold as kind of an analog. And then in 79 is when CTAs became regulated. It allowed people to implement managed futures programs on gold. And the benefit of that over time is that it allowed gold companies to be much more stable, much more predictable, cut the downside, which allows you to compound much quicker. And it exploded. So I mean, the very next year, 1988, there was $300 million worth of managed futures on gold, and then fast forward to 2011, it had 1,000x, so 300 billion worth of managed futures. And the benefit ultimately is that gold is able to fully integrate with the financial system. And if you look historically, we've got a chart that'll be coming out about it. But all commodities have followed that same track, and the only thing really that has changed is over time the timeline compresses, and that's really that's what you guys brought with the hash rate derivatives, and that's what we're trying to do as well, is to compress that timeline for Bitcoin and learn from history and move it along quicker, because I think it's necessary.
So going back to how does your product meet people? Because we're talking about financing, compute, and serving a purpose. How does that manifest? What problem are you solving through financial engineering?
Yeah, I mean, I think it comes back to the point of this panel, which is getting capital to Bitcoin miners, and that's the ultimate goal. And the better you can manage your balance sheet, the better you can manage your currency mismatches that are, just a part of the business, the more attractive you are as a borrower, and the more capital will flow. And I mean, basically what we're doing is, like you mentioned some of the large providers in the space, but this is what commodity merchants across the world do for wheat, natural gas, cotton. It doesn't matter. This is how they manage it. And I mean, really, it's an overlay program that looks at price, looks at trends, looks at momentum, looks at mean reversion, but in a very sophisticated way. And that's what allows the Cargills, the Vitals, the Louis Dreyfus of the world to do what they do, and to last literally hundreds of years. So really, that's what it's about: is staying power. It's about resilience. Anti-fragility, however you want to put it. It's about the being there for the long term, and using financial instruments to really capture that.
Thanks. And one thing that you said and you guys agreed on is you have people who love the asset, they don't want to hedge it. So how do you manage that, for that volatility, the asymmetry? We want to be long as miners and Bitcoin holders. How do you maintain that asymmetry, but manage that asset liability mismatch of cash payments and Bitcoin assets? You want to talk a little bit about what product, a little more about hash. We've heard a lot about it in other panels, but who uses it and to what end, and what really is the unlock that you're providing?
Yeah, and I mean, this room is full of like very risk-seeking individuals, because I think Bitcoin mining is probably, Bitcoin in general is one of the most volatile assets out there. As measured in dollars, and if there's anything more volatile than Bitcoin, it's the ERCOT power market. And yet, so many people are basically not hedging either. So they're producing a hypervolatile commodity by consuming a hypervolatile commodity, and it's quite interesting, because the idea of the hash rate derivatives was basically US dollar denominated product that we thought miners would love to be able to hedge the forward strip, and that if they could lock that in in some way, if the commodity maturation was there, that this would be very popular. And we actually found that all of these their exposure to the Bitcoin price is very important to them. And so we didn't have a lot of traction when we were kind of pushing a US dollar denominated product. As soon as we went to a Bitcoin denominated product, that's where we found our market fit. That's where we found the liquidity. So miners were very interested in hedging difficulty. They're very interested in hedging transaction fees, and really, if they could basically get the value up front in Bitcoin, so they still maintain that upwards exposure, and it became a financing instrument. That's kind of where we saw a lot of market fit, and where we started really feeling like we were solving a problem.
What was that arc of dollar to Bitcoin? Because you obviously can't. How long did it take you to adjust your systems and your business to that need?
I think we're in about the third year of our derivatives platform. I've been at Luxor for just under 2 years, but the derivatives team, I think for the first year, it was quite a grind in kind of finding the market fit. And now, now I'd say it's kind of the standard, and we're having a lot of liquidity, and we're seeing it heavily used. But what's really great for us is, we are seeing it being used to finance the frontier. We're seeing it being used to stay competitive. And, Luxor loves this because, we want all our customers to succeed. So if we can give someone certainty, if we can allow them to upgrade their fleet before it's out of the money, early, based on their current fleet, they can upgrade to the next one, then that's a win-win, because, we're helping strengthen our own customers to survive the next cycle. But yeah, it took about a year, I think, for us to figure out that what we were really offering was a financing product, and we weren't offering a hedging product. And I don't know if it'll always stay that way, but that's definitely what we found so far.
Yeah, I think what I would add is, maybe to state the obvious, but when you go to a Bitcoiner and say, like, you're in this business that's volatile, you've got volatility on your balance sheet, the solution is to short Bitcoin. It's just, in addition to a currency mismatch, there's a philosophical mismatch where it's like, why would I be in this business if I wanted to short Bitcoin? And it's not an easy sell. And so, to that point, I mean, I think the solutions that are currently out there that the bankers are offering is, buy a put. And if you can't afford a put, because puts are extremely expensive because of the volatility, because of it's in contangos, like the forward market makes it very expensive to hedge. And the solution is, okay, we'll also sell a call or do some kind of collared loan. And that's just against the fundamental reason that the people are in the business to begin with. So it doesn't work. So I mean, I think solutions like what we're offering is a little bit different approach, and I think more consistent with what has been done historically.
So we just heard about, I think, people who fund the operations in order to even help capitalize some of the equipment, which is a disaster to fund, not disaster to fund, but very difficult because of the short lifespan. Now we're switching to the physical frontier. Andrew, power purchase agreements, is it more about ERCOT and the changing regulations? If you look at, Rod tasked us with the last 18 months, but I think you even shortened the time frame to things happening pretty quickly as an operator in your realm. So you want to talk about, we're shifting again from the Bitcoin operating front and serving them to you at the power head.
Yeah, I would even kind of wrap up what these guys were saying. And, Bitcoin is really a hedge on the US dollar, and that's how people investing in Bitcoin look at it. And then we look at Bitcoin mining as a hedge on power production. So it's able to monetize your lowest value, riskiest energy as well. And that's what we communicate to energy companies when we speak with them. In terms of, I guess, capital strategies in the data center market, in the last few years, you've had a big move towards AI. The cost of an AI data center, for perspective, so the cost of a Bitcoin data center is anywhere between 50 cents and $1 per watt. The cost of an AI data center is 10 to 30 times higher than that. So you're talking $10 to $30 per watt installed. So they're willing to pay a much higher, like, that's their capex on the data center. So they're willing to pay a much higher price also for energy and the power capacity. Along with that, we've seen some regulatory changes in the ERCOT market. Effectively, we went from a very sort of capital efficient organization where we were paying almost nothing to put in interconnection studies and try to secure capacity on the grid, to where you have new rules going into place that have been evolving over the last 6 months, where you're looking at potentially $50,000 per megawatt. So for perspective, if we are developing a 1 gigawatt data center site in ERCOT, we might have to put up $50 million in order to just get an interconnection study started, potentially. The rules are still shaking out.
And what was the time frame on that again? That new, so last year or last 6 months?
Yeah, it was last summer. The legislative session happened, and then they implemented what's called Senate Bill 6, and then Senate Bill 6 is now being implemented by the PUCT and by ERCOT. and it's just changing the rules significantly. So it's making it much harder to be capital efficient, and then effectively forcing consolidation and partnerships with large capital providers, large data center companies, large energy companies. But I was telling you this morning, even the largest energy companies in the market are maybe 1/10 the size of the largest tech companies in the market. So it's really the big tech companies that have a lot of leverage here, which it's fine. We'll figure it out.
And pressure. So that is, on the arc of this, going back to finance and my background, when I started, there were some convert funds, 4 guys in a room reading prospectuses, managing billions of dollars and making a lot of money. They didn't need a lot of infrastructure, but that's changed because of the need for data and for compute to operate in this business. And right now, those people are now part of larger firms. What are the chances of Bitcoin miners going to be able to operate and maintain ownership and sovereignty in what I just heard was, even a Calpine, is a fraction of the financing power of these hyperscalers? What are the chance of miners staying independent, even as you're trying to maximize operating cash flow and just stay in it? So I guess that's a broad question, and kind of answer it maybe uh, from the near-term hurdles that they have over the next 6 to 18 months.
Yeah, I can start.
Light question for the crew here.
I can start. I mean, I think it's worth delineating between equity and debt, and I think it's also worth delineating between the size of the miner we're talking about. And there's been a lot of talk. I think yesterday, somebody made a comment about the days of someone plugging in a miner in their basement may be over, and there's a lot of the large
Hold on,
miners.
Tyler, we're gonna have to get you back up here.
But and then the pivot of the large miners. So I mean, our focus. I mean, we have our software in most of the large miners, but really the sweet spot is these mid-tier miners. And I think one of the biggest near-term hurdles that I see is that there's a gap between lender and borrower. And a lot of these mid-sized miners will come to us and have need to borrow debt, and just especially coming from the traditional finance side, where we're used to the same situation that these public miners are in, where you can tap public debt markets, you can spin up some sort of a structured facility and have access to capital when you need it. That's not the case for the mid-size and small size miners. And Bitcoin backed loans, I'm glad the previous panel talked about that as well. I mean, it's a good solution. If you've been around a long time, have low basis Bitcoin to use, that's great. But I mean, by definition, new entrants are not in that situation. So, I mean, increasingly, that's not quite the case. And the people who are willing to lend are, what I hear is that either the minimum's too high, the duration's too short, the collateral requirements are too unrealistic, and there's just this noticeable gap between the two that I think, I can't say that I have the solution, but that to me is the biggest problem near term for these mid to small size miners that want to borrow, are in a good position to borrow. They have clean pro formas, really good operations, but the lenders just aren't quite there yet. And there's a new crop of people popping up to meet that need. Sometimes they're not as well capitalized as you would like to be kind of a reliable partner. I think some people are bringing solutions, like Across the Hall Unchained is starting to bring institutional solutions that I think is notable. We're closely related to a company called Firefish that does peer-to-peer lending on Bitcoin, which is closer to kind of the Bitcoin ethos, no rehypothecation, that kind of thing. So I mean, solutions are starting to form. I think the answer might just be that the market needs to mature a bit, but this is one of the hurdles that I see in the near term.
Okay, thanks. And Andrew, I'm gonna go back before I go to you, Haley. You're bringing the perspective of both the data center and the miner. So what observations do you have about the operating dynamics, the landscape today, about miner to data center here in May of 2026, say a year from now, miner to data center? How's that ecosystem changed? Are they partnering? Are they competing?
It's a really tough question. I think Bitcoin mining is right now still a very good investment. I think that's what's interesting about it. The machines are cheap. If you have access to power, you can mine very cheaply. The energy is cheap. You're making money. You're printing, the future money, and that's going to be worth a lot. And the question is like, what can you make for, say, your data center capacity today alternatively? So whether you're leasing your space to an AI company, whether you're selling the entire data center space to an AI company, you can really sell that at a premium today, and then go, if you're a Bitcoiner, go back and buy Bitcoin, and then hold a little bit longer and maybe buy those assets back, 5 years from now.
Okay, so you heard that arbitrage strategy right here.
Yeah,
right?
it's
Mining fiat, investing Bitcoin, and then when they poop the bed, you buy it back from them
exactly.
later.
Yeah.
Okay.
So
And to add to that, I mean, I would say, if you look at where Bitcoin mining started and where like it started in garages, it started as a hobbyist thing. This is actually where I think it thrives. So I very much believe in the wisdom of the markets or the power of the markets. I think that the markets are telling Bitcoin miners and essentially, especially the mega miners that they're not actually potentially they're not actually Bitcoin miners. They're data center operators. A lot of people are now, pseudo energy traders or energy companies, and that's kind of that's what the market is saying. We're going to see, it's going to be very interesting. So to your question about a hurdle, I think the halving is going to be this huge hurdle. Really, the hash price is, after the halving is going to kind of dictate that future. But if we were in a future where Bitcoin miners, we're back to what I would say is the true frontier, back, kind of off grid, or you needed a negative energy price to mine Bitcoin. And by that, I mean, you need to be solving a different problem, heating something, or, using stranded flare gas or something like that. I think the Bitcoin, ecosystem would be fine. Like there's going to be some pain in that, but I don't think that's a lights out scenario for Bitcoin. I actually think that's where, on a longer term cycle, Bitcoin miners thrive because they're innovative and they're scrappy, and they're like, the reason that the hyperscalers can move in is because of all the work that the
Yeah.
Bitcoin did building the frontier.
Yep.
So to your arbitrage, if the move is okay, write me a check that's 10 times, 30 times, what I was expected to make, and then I'm going to go, do something, find a different frontier. That's where I think Bitcoin miners, that's where I think their DNA is. So I don't, it's an interesting dynamic, but I think it's going to end up just fine for Bitcoin, but maybe not all the individual companies. But I think some Bitcoin mining companies are just going to become, HPC companies and energy companies.
Yep.
And it's already happening.
And then hopefully then they'll realize that 4% of stranded energy that they have, they can go back into Bitcoin. Anything on your side?
No, I mean, I think that pretty much covers it. I mean, it's like you said, these things move in waves. These things move in regimes, and right now, if you say you're raising money for HPC, you're going to get a lot of capital behind you, and that wave is here. That wave will settle down, and things kind of rotate. I agree. The market will speak, and it has a way of sorting itself out. So, I mean, I think we just got to keep our eyes on the prize.
You talked about the CME, I think starting in 74, 78, something like that. And it's good to notice why that happened or what else happened, which is Black-Scholes unlocked the option model a couple years before the CME was able to expand, to go from that, what'd you say, 300 million to 300 to 100 billion or whatever the number was. So having data and having models, which is what these brains here literally and figuratively are doing, is needed in where we get power, we get compute, and we get the non-incentivized financiers to engage. They need a surface area of data. Thank you, Margot. They need a data set from hash rate, from demonstrable, proven, engaged, closed transactions in order to model out and then add. So right now, financing is way expensive for the Bitcoin space. It will be for a while. You need to leverage your house, unfortunately, to get cheaper capital. But staying in the space and the innovation, I think, that you guys are providing will continue. I guess what we'll do is maybe some closing remarks and some Q&A. And hopefully we've identified the frontier, the physical aspect, the compute, which is very dynamic and also requires physical, and then the funding aspects, which less PPA in this conversation, but hopefully you follow up. Operating capital, how to manage your operating cash flow, align asset liability management. Then they have decisions and options. That's the mother's milk for these Bitcoin miners, obviously. So any thoughts about what you would like to see, or what you think will be news that's maybe not in the marketplace in the next 6 months for miners or power in general?
Yeah, I mean, I think just bringing, I mean, like I said, our view is that bringing sophisticated balance sheet management, it's time to do that, and I think that Bitcoin's ready for it. And after spending more time than ever thought I would studying the history of commodities, like the unlock that it can create, I think is real, and I think it's really just about being able to withstand these ups and downs, and brains will always be focused on Bitcoin. That's where we were born. That's where we'll always be. And I think I have been really impressed with how the company Brains has withstood the ups and downs throughout time. I mean, I think the being here since 2010 is a testament to the decision making and just the resilience of the company that I work for. But bringing that mindset in a more sophisticated way, and with a team that has a real background in doing it, is something that very excited about. And I think it's ultimately going to be a big win for Bitcoin, the asset.
I mean, so to your question, what I would hope to see is, I think that the Bitcoin mining industry has matured an unbelievable amount in the past, 10 years, 5 years especially. It looks a lot more like a traditional commodity market. People are starting to think about it that way. I think, so through something like a hash spark spread that Luxor can provide, where you kind of hedge the power and the hash rate, that to see that traditional finance treat Bitcoin miners as, to reward that maturity, that a miner could engage in that and say, look, my costs are certain and my revenue is certain. I just need to stay online. And then they become as financeable as any other, industry, as any other operation. I think we're starting to see that, but I'd like to see more of that. And because it can be tough as a Bitcoin miner. Initially, the capital requirements were very high, to get on grid, and your prices would double, your insurance rates would be, ridiculous, and there's really no reason for it other than this kind of, viewing it as an immature cowboy industry, and I don't think it is anymore. I think, products like yours and some of the ones that Luxor have helped mature it. So I'd like to see, I'd really like to see someone give a big loan to somebody who's hedged their production, and kind of reward them for, looking more like just a traditional commodity company.
Okay. And you mentioned something about a shout out to people saying, let's band together and, tie our boats because the halving is coming, and to endure the wave, of that drop in supply. You want to talk about not FERC rather, but ERCOT, sorry guys, about getting support in order to manage some of the regulation that's coming, or to get together. I don't know if that was something in our
Well, yeah, absolutely. As a call to action, and kind of to your point about Senate Bill 6, I think multiple people in this room have over a megawatt. The TBC is doing an amazing job, kind of being a lobbyist for the industry. And so for I think only $3,000 a year, you can be an ERCOT member, and we almost have the numbers to actually have a voice to kind of change some of the outcomes. So as something that people in this room can do, it's go be an ERCOT member, and join up with the TBC, and basically let that kind of be a lobby group for our interests, because they do a fantastic job, and we should see more miners become an ERCOT member. You don't need much load to be one.
Well, I think, Andrew, you're pretty close to ERCOT and the variability or the changes there. 6-12 months from now, what would you say is a hurdle or an opportunity for the Bitcoin miners to engage?
I'm going to dodge that question a little bit, and I'm thinking more in the 2 to 5 or 10-year range. And I look at the problems and the opportunities that we have today, and they're probably very small relative to what the world looks like only in a few years. And so I look at what artificial intelligence is doing, and I fully expect it to drive down the prices of most goods and services to near zero, and at the same time, all assets being repriced in Bitcoin. And I think we get to this point with artificial intelligence in the next couple of years where it's really the responsibility of Bitcoiners in this room, no matter how big, how small, to be the capital allocators of the future. And it's going to be a lot of capital allocation towards further energy and compute infrastructure, which is producing intelligence. And it's also going to be investment in other important parts of human society, whether it's education or food, water, any of those things. and that's going to come at us very, very fast. So I've got a $50 million problem today, but 5 years from now, it might be I need to make a $50 billion capital allocation decision.
Thank you. So it sounds like stay in the trade with intelligence, proper capital allocation, because finance doesn't care about your business, and they really want certainty, and that's what this team, I think, is providing to their clients. Anything? Any other Q&A or